Tomorrow kicks off bank earnings. We're not going to play individual names, but banks are interesting here. And
no, they're not. I don't think they're interesting, and I don't think they're important.
This is how quickly it takes to become a clown on CNBC television. You only got to be right once to make your billions. Steve Eisman shorting the 2008 financial crisis, only to come on CNBC a few weeks ago, just battering the crap out of how uninteresting, how garbage bank stocks are. Meanwhile, guess what's one of the best performing sectors over the last month, pretty much since that video came out? Of course, the financial sector, the banks, PayPal, all this stuff is skyrocketing this month, even outpacing tech. You know how insane that is? I'll give you an example here with Wells Fargo, but you got to understand that this has been one of my bull theses and why I've been gobbling up bank stocks as of last month, and that's just because the Fed is still raising rates. We just saw them hike another 1/4 percentage point. What is that doing? Well, they're just trying to get inflation back to where inflation should be at 2%, and we're almost there. It's likely we're seeing the end of interest rate hikes, and probably next year I wouldn't be surprised if they start lowering them, presume we don't have a black swan event where inflation skyrockets or something again. But in the current macro environment, interest rates benefit banks. It leads to higher interest income for them. That is what's been driving these stocks. We just saw Wells Fargo post. I mean, look at Wells Fargo in the last month is up 13%. To put that in perspective, Tesla's only up 5.6% in the last month, 4.4% on Apple, and Meta stock, even after an astounding earnings, is only up 10.8% this month alone. Now, Wells Fargo here has been doing all the things we want to see. Not only are they crushing their earnings right now, they're doing $30 billion in share buybacks. They've increased the dividend pretty dramatically here. And look at the numbers. The numbers just don't lie here. We're taking a look at total revenue sitting at $20.5 billion over this time last year, where they only did $17 billion. And you want to take a look at the actual driving common denominated factor here, net interest income. He's just talking about all the regulatory fronts and issues, but the thing facing you that's actually like raising these ships is it doesn't matter all the regulatory issues. It doesn't matter that, you know, some people might have higher credit card debt, that they're putting loan loss provisions aside. What matters is the fact is their net interest income is sitting at $13.1 billion over the same time last year where it was sitting at $10.1 billion. I mean, you take a look at most of the other incomes they have, they're generally just flat, and it isn't substantial growth. It's still growth, but it's nothing like the interest income they're bringing in. You look at Bank of America here, 15.9%. I have been touting these things have been a buying opportunity, while everybody on CNBC is stay away from the banks, just buy tech stocks, just forget the rest of the market. These top 7 stocks is all you need to hear about. It's all you need to buy. It's not the case, especially if you are a dividend income or you're looking for cash flow, you're in your retirement, you want some stabilized investment. These infrastructure-based companies, you think the banks are going, if all these banks just went under because we went into a horrible recession, you think you're going to be worried about your stocks if we saw something worse than 08? Just stop the market that we're in. Net income for Bank of America rose 19% to $7.4 billion. Net interest income here up $1.7 billion or 14%. Good job, Bank of America. Look at JP Morgan. This was the only one Steve Eisman was like, oh, if you're going to buy one, you might as well buy JP Morgan, up 13.7%. Clearly, all the other large banks are doing just as well. JP Morgan here has just been crushing it from the October lows it experienced last year. And just take a look at the net revenue here, sitting at a whopping 41 billion, guys. 41 friggin' billion, up from 30 billion this time last year. Are you freaking kidding me? I mean, you just read into some of this. Net interest income was 21.9 billion, driving half of the freaking revenue, up 44%. Oh my God. And dare I even say Charles Schwab Corporation, the one that just got beaten into the freaking ground, baby. Look at this one, up 21.5%. Look at my bank stocks here. I've been loading the boat on the Canadian counterparts. Canadian banks are going to be posting earnings coming into August. So we have to be a little bit more patient because the Canadian bank earnings lag the US. But if that is a defining factor, I feel like I'm sitting in a pretty damn good place. And I kind of made this bet. I don't know what bank stocks are going to perform the best, but I like the monopolistic control the Canadian banks have. They're a little bit higher regulated. They tend to be a little more stable, pay higher yields than they do in the US. And I just decided to, hey, I'm going to make my own bank ETF. Why would I buy and pay a fee to make a bank ETF when there's only like 5-6 major banks in Canada? So what I went ahead and did is I upper weighted the largest banks, and I said, go back, watch my videos. If I had to make a bet on what the best performing bank's going to be, it's probably going to be Toronto Dominion Bank. And look at that, dead on. Toronto Dominion Bank's up 8.58% since I loaded the boat here. Upper weighting Royal Bank and Toronto Dominion. And then I decided excited because obviously the lower banks, they've been struggling. They're not seeing the same kind of revenue growth as these larger banks. I just said, hey, let's make my own ETF. I'm going to lower weight Canadian Imperial, Bank of Nova Scotia, and National Bank. Those ones slightly underperforming, but as a whole, as a basket, without just buying an ETF, these things are just damn crushing it. Over the last month, TD's up 8.11%, Royal Bank's up 4.5%. And again, not nearly as resilient as the other banks, but we haven't got into earnings with these guys yet, but it's a good defining factor of what we can expect here. National Bank, look at this, up 5.7%. And BNS, these ones have been lacklustering, but you're locking in a massive yield with a lower price to earnings multiple than some of these US banks. And I got to kind of pivot here a little bit. I hate that people have been crapping on the dividend community so much. I mean, last month, everybody was just crapping on SCHD. Oh, SCHD is now underperforming the S&P 500. Why would you buy SCHD? Even though it was down over the last month and it was underpacing a lot of the indices because everybody was focused on tech. But you know what? You could have locked in a great yield, 10% ago, like we were saying. I mean, SCHD, it's the one that I just loaded up on. It is the primary controlling ETF. I'm leaving in my RRSP here, and it's just been doing fabulously. I mean, again, it's not nearly at the pace of the S&P from all-time highs. I think the S&P again is down just a few percentage points. Lock in, I think, the 1.5% there, give or take, that you get on the S&P. You're probably damn near close to all-time highs. You bring in that 3.5% yield, you're really only down about 3% on Schwab. And if you've been cost averaging, like we mentioned, you should be in the green. I mean, look at the position I have on the Schwab US Dividend Equity ETF here. The financial sector, as mentioned, the lower half of the S&P, those stocks that people have shrugged off, is where new money is going to go. I think that's what's going to drive the new all-time high because everyone flooded into tech. We're seeing a breath taken back on anything that got too overbought. Microsoft, I'm expecting, I wouldn't be surprised if we see it even with Apple on earnings, that there's going to be a bit of a pullback. So all that money doesn't want to leave the market, I don't think. They don't want to go back to bonds. They don't want to go back to GICs. They're not going to be doing any of that because they know that the market's kind of refurbished this bullish idea and they're going to chase it. There's just too much money on the sidelines and they're going to go to where the value looks to be. And now that the lower stocks are starting to rally back, they're going to catch that as, oh, a new bull run. Let's buy those stocks because the yields are better. They're seeing great returns, whereas tech is going to start pulling back. I think that's potentially speculatively what's going to happen, but I love having SCHD because it gives me that exposure to what's been beaten into the ground. It's still holding up great. You got to remember, I sold out of Tesla in this account, making wicked gains, and this account is still holding pretty much its all-time high because I pulled out of Tesla at great points. Yeah, a lot of you have been asking me, why haven't I been buying my tech stocks back? You talk about it all the time, and that's because we still have a large exposure to tech companies, guys. I haven't given up on tech. If you follow these videos, it's this combinating factor of my fiance's portfolio mine to try not overweight specific companies. And because we have such large weightings in the S&P 500, this is what our kind of combined exposure looks like. You take those top weighted tech companies and you hone in on the fact that my fiance owns a huge percentage of Meta still. She's got decent chunks of change in Apple, Microsoft, Amazon and Google, a little lower weighted. Yeah, that's probably only maybe 7 to 8% of our entire portfolio, but that upper weights those tech companies we have the exposure to in VOO. And then of course, SCHD being the next largest position here. So you can see that if all in all you'd comprise this portfolio down, tech companies would make the largest weighting, but we have little exposure to the Canadian economy right now. We really just have our major exposure to the banks. TD, thank God TD is one of the largest positions that we hold at 3.58. And you can see that we're not in this new wave of, hey, we're just loading all our money and doing 10% exposure ratings to tech like I used to. We just bought a piece of real estate. We put a massive amount of our assets into that real estate. So we have this nice exposure to real estate. Now we want to rebuild these portfolios back, and it's likely we're going to keep focusing on somewhat of the Canadian economy as we begin to retop up our tax-free savings accounts. We start rebuilding that back because that's where we pulled the deposits, the down payments from, things like that. But I think this portfolio is very healthy where it sits, and this is why I haven't been just loading up on tech companies because they've been getting chased too much, and I don't personally like buying them at the highs here. I wish I was buying them at the lows. I wasn't intelligent enough to pick them up at the bottoms. I'm not perfect. I'm just as much of a clown as Steve Eisman. Don't ever buy what I'm telling you to do or anything of the such. I'm just sharing what I like to do and my thoughts, and it's worked very favorably toward us. I mean, we're up a huge percentage on these stocks. We rode these stocks literally up till pretty much the mid of last month, pulled that money out for the deposit, so we managed to get a lot of the rally back from October, staying within the market. That was a huge benefit, and now we're getting even more benefit just sitting here. The capital gains we've got off our current portfolio, our portfolio is up combined between 13 and 15,000, excluding the dividend income we've been raking in, and we are not the most dividend income oriented portfolio either. We're trying to find that balance at 31 years old of growth and income. So I mean, our yield with a portfolio size could pretty much cover our entire mortgage expense if we want to, but we have great incomes. We have combined incomes. I run a business. We basically have 4 or 5 sources of income here, making 6 figures a year between us. Like, we're in a great position to continue to start building back this portfolio and hopefully fast track to an early retirement sometime in our 30s and get that mortgage paid off, which if you want more details on, I'm going to obviously be doing a full live stream tomorrow night at 9 o'clock like we do every week on this channel. And obviously you can support the Patreon if you want to see more personal insight into our finances, this real estate deal, and some more on the stock portfolio as we kind of close things up and get the finances worked out. Links down in the description below, but I'll pass the question off to you. I'd love to know what you think, as always.